Hi everyone, I'm Ricardo Gonçalves and this is SBS on the Money for this Friday, the 12th of March 2021. It is a bit of a shorter version of the podcast and live stream today. The Australian share market rose up by 0.8% on the 200, 6,767. The miners did well, but tech stocks fell. For more on the day's market action, I spoke earlier with Rob Holder from Crestone Wealth. So Rob, the market is stronger today. Why?
Yeah, as always, so is often the case with the Aussie market, we follow the leads from offshore. And last night we saw the European Central Bank coming out talking about buying more bonds, suppressing bond yields, which has been a focus of markets recently. And in the US, we also had the Treasury there getting away a 30-year bond auction without moving around bond yields too much. And I think markets took heart from that. And then the Aussie market's following suit today.
I want to talk about bond yields in a moment, but first, one thing driving the market today is technology, right? It's been really volatile, that sector, and I loathe to keep talking about it, but it does have all these huge swings. Why?
Technology is an interesting one. So very strong performance last year, and what investors are essentially buying is this growth story, and a lot of that growth is a long way into the future. So what we're seeing over the last sort of couple of months is those general growth expectations for the market as a whole and for economies as a whole moving higher. And when you think that you can suddenly get a lot more out of your dollar invested in terms of risk-free government bond yields, it makes that growth that you're paying for in long-term tech growth a little bit relatively less attractive. So investors therefore prepared to pay a bit less for the tech growth that they would have paid for, say, a few months ago. And bond yields are moving around a lot. Growth expectations are moving around a lot. And therefore those tech names, as you said, are kind of all over the place at the moment.
One of the stories that I liked this week was the RBA governor trying to jawbone the bond market essentially by saying, hey, we know you guys are moving long-term interest rates, but we're unlikely to be doing anything with interest rates until 2024. Has it worked?
I think a combination of what they're saying and what they're doing has worked. So before that sort of commentary is coming through, we're seeing them increase the bond purchases that they're making in the market. So the Aussie 10-year bond yield shot up to 1.9%, and they suddenly doubled the number of asset purchases that they're making, and then the bond yield comes back. So there'll be a combination of action in the market, but also a lot of chatter from the RBA around not getting too far ahead of yourself in terms of where bond yields are headed.
So given all of that, how do you invest in this environment?
Yeah, look, our advice and what we have our clients doing is really not a great deal different at the moment from what it is in any other environment. And the most important thing we think is to maintain a diversified portfolio. So don't get too overconfident. Don't have all your eggs in one basket. There's still plenty of risk out there. And if you do have views as to where you see value within this market, don't go chasing that too aggressively. Tilt your portfolio in that direction, but certainly don't be jumping all in or all out of particular asset classes.
And speaking of value, where do you see it in the market?
I think there's a couple of different ways of thinking about this. So one is in terms of sectoral themes that you might play. And I think what we've already said about tech, I think that theme is probably going to continue. So growth expectations in our base case scenarios are going to continue to improve, and that will see tech probably a relative underperformer. And at the same time, some of those cyclical recovery stories as we get back to normal will be a relative outperformer. So think financials, think consumer discretionary, luxury goods. So we tilt our portfolios towards those at the moment. And what that also means is that certain regions are favored. So the US, which is pretty tech heavy, would be less favored at the moment. Markets such as Australia and Europe, which have more of those financial kind of flavor to them, we expect to be relative outperformers. And then the UK was also an interesting one at the moment. We've seen Brexit risks decrease over the last few months, but we've also seen this sort of rapid rollout of the COVID vaccine there. Valuations are very cheap. So that's another area where we think the sort of domestically focused UK equities is an interesting place to be at the moment as well.
Rob Holder there from Crestone Wealth. That is SBS on the Money for this week. I'm Ricardo Gonçalves. You can follow me on Twitter and Instagram at Business Ricardo.
This On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It's not personal advice and it doesn't consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.